Mon nom c'est Ralph Dagfal et je suis directeur principal chez Adanda Capital et dans ma vie de bénévole, je suis vice-président événements pour CFA Montréal. Alors, premièrement, j'aimerais vous remercier d'être tellement nombreux. On est surpris et pas trop surpris, étant donné le thème est intéressant, mais quand même, la salle a été pleine en 4 jours, donc l'année prochaine, on va être peut-être le double. Donc, j'aimerais vous remercier pour être parmi nous pour ce déjeuner-causerie. Qui est le thème de ESG, The Future of Investment. Donc, depuis maintenant, ça fait 2 ans que nous avons au moins une conférence sur les thèmes ESG à CFA Montréal. Et c'est surtout la demande qui est tellement intéressante et importante pour toutes les catégories d'investissement. Donc, notre conférence aujourd'hui est avec la collaboration de Finance Montréal, PRI Québec et IFD, que nous remercions. Et aussi, j'aimerais prendre 2 minutes pour remercier tous nos commanditaires Adanda Capital, CIBC Gestion d'actifs, Desjardins Gestion internationale d'actifs, Finance Montréal, Horizon, MFS Investment Management, Investissement PSP et Triacima. Alors, sans tarder, j'aimerais vous présenter Christopher McNett, qui est the Managing Director of State Street Global Advisors and Head of ESG Strategies. He's responsible for delivering SSGA ESG value proposition for the marketplace and helping clients develop and implement their ESG strategies. Chris is a member of SSGA Proxy Review Committee and State Street Executive Corporate Responsibility Committee. He's also a member of the SSGA Senior Leadership Team. Before joining SSGA in 2007, Chris worked for KLD Research and Analytics. Chris is a first mover fellow at the Aspen Institute Business and Society program. He earned his MBA from the Daniel College of Business at the University of Denver and a Bachelor of Science in Business Administration from the University of Connecticut. Donc, Chris, please come in.
Thank you. Thank you very much. It's a great honor to be here. And as you were speaking in French, I was just hoping that you were saying nice things. And then very, very nice of you, you gave the bio in English, so thank you. Look, it is great to be here with you today. And I have to start with a confession, which is that it's a bit humbling to be in front of a room of so many CFAs. Raise your hand if you're a charter holder. Yep, see, there we go. So I have a confession to make. It's not that I'm not a CFA, you know that, because I don't have the letters. But when I entered the profession for a second time after business school to focus on ESG, I had this to CFA or not to CFA debate in my head. And I had a bit of study fatigue from graduate school, so I put it off. And then when I started to revisit the discussion, I just got engaged. And then my wife convinced me to put it off. So here I am working with many of them in my firm. And that's a real treat. So I don't have it yet, but I really want to acknowledge the great work of the CFA Institute on this topic in terms of adding content, holding seminars, doing surveys, et cetera. It's really something that I really take notice of. And it's a really valuable contribution to the field. And my colleagues, local colleagues in Montreal, have been really singing the city's praises when it comes to leadership on sustainability. So I just had to come and see it for myself, and I have to say with this turnout, you've corroborated that opinion. So this is really great. I also want to thank all the co-hosts as well. And I want to start by talking about my firm, State Street, and our mission. And our mission is to invest responsibly to enable economic prosperity and social progress over time. And that's the firm's mission. That's not my mission. That's not the ESG team's mission. It's the firm's missions. And one of the ways we fulfill that mission is by integrating leading ESG frameworks into the portfolios of our clients. And that work is guided by a number of beliefs. One is that we think that companies that are managed responsibly will deliver better financial results to our client over the long term. And we think that our role as long-term stewards of capital provides a powerful opportunity for us to engage and encourage responsible investing. And we also think that the impact of our investment activities can be managed for a positive contribution to society and future generations. And so as someone who's been working exclusively on ESG investing for 12 years, the last 10 of which have been at State Street, I can't tell you how affirming it is for a nearly $3 trillion asset manager to have those sentiments. And that's a little about us. I want to talk first with where we're at in the market. So sort of the arc of my comments will be, what's the current level of adoption? And we did a survey of global asset owners about a year ago, nearly 500 of them, and found 80% had some ESG in their portfolio. And we were absolutely astonished by that. One of the familiar refrains of ESG is that it is or is becoming mainstream, and this finding, at least in institutions, certainly corroborates that fact. What forces are driving this? And also, we shouldn't get too bullish just yet and read too much into that headline, because the depth of integration really varies. Most asset owners have it across only about a quarter of their portfolio or less. Why is that? But the momentum will continue. On that, we're absolutely bullish. There's a number of reasons. The investor experience has been overwhelmingly positive. The sustainability imperative just becomes more and more acute each day. But there are barriers that we need to overcome, so we'll talk about those. So I want to start and step back a bit to our firm. We are the third largest asset manager in the world. We're one of the world's largest index managers with about 2.7 trillion in assets under management. And globally, we have nearly 12,000, more than 12,000 companies in our portfolio. This makes us the quintessential long-term investor. We're providing long-term, quasi-permanent capital to these companies. As long as the stock is in the S&P 500, we're not going to make it the S&P 499. We're not going to make the S&P TSX 59. We're hired to give our clients the benchmark exposure, and for us, risk is any deviation from that index. But this is where stewardship enters. As stewards of our clients' assets, we've developed a stewardship program encompassing a range of environmental, social governance issues that might impact long-term returns. And we assess and take action on ESG risk factors across all our portfolio companies. Fundamentally, this is about how we mitigate risk in our portfolio. And leveraging the full force of our equity stake, which is considerable, it's also our primary lever for impact. And we're looking to build a better, arguably more sustainable beta. We're trying to improve the quality of the normal returns represented by the market. And we believe that companies embracing ESG best practice have two hallmarks. The first is strong, effective, independent boards. For us, that's a precondition for long-term value creation. And we think a strong board with relevant skills and diversity of backgrounds and viewpoints, and which is not held captive by management, is best placed to articulate and hold management accountable for strategy. And our research has shown that companies with strong female leadership perform better than those that don't. Studied by MSCI, so it's not just our research, but other research, found that companies with a critical mass of women leaders at the top generated about 36% higher ROE on average than companies without. A separate study in January 2017 confirmed that most of that performance is attributable to the presence of women on the boards and the independent perspectives and the diversity that brings. At more of the macro level, McKinsey has done some really excellent research, and they found that if women were to participate in the global economy identically to men, that would add up to 28 trillion of additional GDP that would come in to the economy by 2025. So it's the research tying the presence of women on boards to performance that drives our conviction that increasing gender diversity in company leadership will benefit our clients, but also the economy over the long term. And that's why in March 2017, we issued guidance to companies in several markets to help them assess and enhance their diversity. Fearless Girl was a way to boldly symbolize that belief. And since the day she was installed, we have focused on more than 700 publicly traded companies without a single woman on those boards. And of those 700, 152 have since added a female director to their board, and another 34 have committed to do so. We voted against 500 companies that failed to take action. So we've seen encouraging results. In 2018, we extended this to 2 markets, Japan and Canada. We evaluated gender diversity on the boards of more than 700 companies on the TSX. We found that 268 companies or so didn't have gender diversity. So in February of this year, we wrote letters to them, the ones that are lacking board diversity, and that letter included our guidance and our voting procedures as regards gender diversity. And really our preferred approach is to drive greater board diversity through an active dialogue and engagement with company leadership. But in the event that companies fail to take action, we will use our vote. That's sort of the stick, if you will. Another hallmark of ESG best practice is companies integrating sustainability into their strategy. And we have a framework for evaluating companies based on each company's approach that does three things, really. Looks at three things. Has the company identified the material, environmental, and social sustainability issues to the company? Where relevant, have they taken steps to incorporate those issues into a long-term strategy? And just as importantly, are they adequately communicating that to the market, to us as investors? We use this framework to categorize companies based on how comprehensively they are considering sustainability risks and opportunities. So why do we do this work? Well, we think in the past, a great company had to be operationally excellent and financially sound. That's still true, that's fundamental. But we think a great and sustainable company today and tomorrow needs to also be ESG proficient. And really, if you look at the composition of firm value over the last half century, it's really dramatically shifted from tangible to intangible assets. And investment theory centered on determining intrinsic value, that's really linked to physical assets and book value. And we think that needs some recalibrating. So the mosaic theory of investing, that is that all material pieces of information can be put together to form a complete assessment of an investment opportunity, is undergoing some changes. And the rise of ESG reflects also a shifting economic landscape, one in which some of the greatest global risks facing economies, institutions, and people are outside the purely financial realm. These are some of the effects related to climate change, like water scarcity, extreme weather, but also things like the growing risks around cybersecurity. So look at this visual, courtesy of the World Economic Forum. Each year they rank risks from hundreds of risk experts across the world in terms of their likelihood and impact. And in the early years, represented in blue, they were almost all economic risks. In the last 10 years, you see a lot of green, you see a lot of red. So environmental and social risks combined are outnumbering economic risks by about 2.5 to 1. And I think we have to acknowledge that conventional investment analysis by itself hasn't really adequately captured these forces and these themes. Now, we're known first and foremost as an index provider, and we're proud of that. Less known, or overshadowed, I should say, by the sheer scale of our indexing is a very vibrant active management complex. And in general, our active teams view ESG as complementary information that can contribute to the pursuit of alpha or the management of risk. And for that reason, the majority of our active and fixed income teams do now incorporate ESG into their investment decision making. Strengthening the integration of ESG across investment strategies is an ongoing focus of the firm. We've got more work to do. Our clients expect it. We don't have all the answers. But we think sharpening our pencils is work worth doing, especially as new information and tools come into view, like this. So I want to give you a few quick examples. Our active quantitative equity team, they view ESG as a non-traditional metric that captures these difficult to measure corporate characteristics that have low correlation to financial quality measures. And by non-traditional, I mean that they don't neatly reside in the financial statements, but they still capture important management actions like the quality of corporate governance, their environmental risk profile, and the strength of their relationship with labor and communities. And the team thinks that a high ESG score can signal that a firm is in good health, well-managed, and future-oriented. But they also think that ESG can be an early warning signal, as poor ESG evaluations signal companies that are more prone to scandals, which can then distract management and in comparative valuations, both today but also into the indeterminate future. But really, materiality That's the tailoring of ESG evaluations by industry relevance is really vital to unlocking its alpha potential. And there are a myriad of materiality viewpoints across the market. Our team studied a panel of these and identified the consistent themes by industry, and then they built a proprietary ESG factor that targets those material themes at the industry level. And that's now brought into the stock selection model and informs the evaluation of all stocks in their investable universe. Switching asset classes, our investment grade credit team, they integrate ESG into research and credit selection process. Corporate governance really spans across as an important part of the research process in all contexts. Environmental and social issues are a little bit more case by case. That shouldn't be surprising, as they are deemed material to a particular industry, or issuer rather. So for the utility sector, their investment process involves scrutinizing companies' approaches towards managing environmental risks and gaining insight into their current and prospective fuel mixes. So what do they do with that information? Well, they typically avoid investing in companies with significant coal-fired assets, or they demand additional compensation from companies that might have execution risk in this transition to a cleaner generation and a cleaner economy. So it's not doctrinaire. It's more nuanced than that. So I ask you, is this evolution or revolution? I think it's sort of quiet revolution through evolution. There can be such a thing. So back to our survey. I'm going to go outside of the firm now. We found that most of the investors, they have a no compromise approach when it comes to the performance of ESG investment strategies. They accept the same performance as they do for other strategies, and they haven't been disappointed. 69% of them said it had helped manage volatility, and nearly the same amount said the integration of ESG had significantly improved returns. So to be sure, ethical and responsible investment criteria remains vitally important. Greenwich Associates did a survey of 150 Canadian and US asset owners last year, and positively impacting society was the top objective of using ESG in the portfolios, just ahead of risk. So there's very much an emerging and dynamic demand picture for ESG. In addition to an evolution from exclusionary to integrated approaches, clients are looking to increase their exposure to ESG while maintaining a broad, diversified universe, or to make targeted allocations, sometimes with the objective of achieving a measurable social and environmental outcome. But any way you look at it, in the last several years, there's been a marked increase in the number of our clients that we've spoken with that are interested in exploring ESG investing. So based on hundreds of conversations with clients over the last 2 years, we've compiled a set of the most common issues that have surfaced in those discussions, the challenges that clients want us to help them solve, and I want to share some of them with you today. Off the top, in a space where facts are scarce, one fact is incontrovertible, and that's ESG is not monolithic. The why and the how is really still by and large idiosyncratic. Fitting some patterns, but it's still really firm specific. The most common concern is performance. I just can't escape it yet, despite everything that I'm telling you. You've heard it before. Surely there's got to be a trade-off, right? There just has to be. It's too good to be true. It's like motherhood and apple pie. But this is still the dynamic, right? It's waning, but it's still the most frequent issue raised among non-adopters. And this perception reveals, I think, a misunderstanding stemming from earlier related forms of investing that are predicated on excluding companies or industries from the portfolio. Now, for sure, for some investors, subtraction can be addition in the form of the utility that they derive from aligning their portfolio with their values, or for a pension fund using selective divestments to manage reputation risk. But for the ordinary fiduciary investor like most of you, subtraction can be anathema to a long career. So the modern school posits that ESG is additive to the investment process. It brings in new information. It enhances the analytical toolkit, helps form a more complete assessment of an investment opportunity. And recent aggregated academic evidence is largely supportive of that investment thesis, finding a strong correlation between high ESG and lower cost of capital, better operating performance, and superior equity returns. But ESG is not a silver bullet, right? You already know that. Just like factors or styles, sometimes it will work and sometimes it won't. The second most common concern is uncertainty how to define and measure ESG, along with broader challenges like data. The problem with this is that many of the terms used to describe the various ESG strategies and approaches mean different things to different investors. So there's a lot of confusion that prevails, and I want to commend the CFA Institute for being clear about how they define ESG investment approaches. But this confusion, it absolutely impedes organizational alignment. And then that undermines the ability to effectively implement each strategy, let alone to benchmark success of the strategy. And this challenge that we found, this is flagged by adopters of ESG. So you can imagine how vexing it is for non-adopters who aren't familiar with the language and the landscape to try and make sense of this. So for these reasons, we wrote a paper to help investors compare and understand terminology and select the best strategy for them. And that's not at all provocative, but this is nuts and bolts stuff, and that was actually the piece that we've used most in client conversations. So we know that today investors they are increasingly accepting that material ESG factors can affect financial performance and may also have important societal and environmental outcomes associated with them. But obtaining data from companies and reaching consensus in the marketplace about which ESG factors materially impact each industry is still a really daunting challenge, right? This is because ESG systematically but differentially affects industries and companies. That shouldn't be a surprise though, right? I mean, a fundamental analyst doing a DCF on a bank wouldn't have the same inputs as they would for chemicals. It wouldn't be the same for ESG either. But who's to say what those things are? Right? So the biggest barrier to effective ESG integration is the lack of standardized high-quality data to incorporate into the investment decision-making process. Disclosure by listed companies has improved markedly. The quantity's gone up. Quality has really not gotten better. Reporting is voluntary and heterogeneous. It's not uniform. It's often not comparable. Now, data providers and rating agencies have stepped in and filled the void, and they're providing a valuable service to investors. The downside is that they have differing methodologies. They often reach different conclusions on the same company, and there's a lack of transparency, frankly, into their methodologies. It's getting better, but it's still lacking. So for these reasons, we support industry efforts like the Sustainability Accounting Standards Board on the development of standards that identify these material topics and metrics by industries, which companies can use to inform their disclosures and investors can use to inform their investment analysis. It's also why we signed the Declaration of Institutional Investors on Climate-Related Financial Risks organized by Finance Montreal. This is about pulling forward better information for us as investors. So I like to think of material ESG issues as part telescope and part microscope. Now, through the telescope, we see trends which are building over time and in many cases are systematic. Climate change is one of them, but it's not the only one. That's the 800-pound gorilla. And that's why we are also supporting the Task Force on Climate-Related Financial Disclosures. But through the microscope, we try to discover that small subset of ESG issues which are material and informative to making that investment decision. The elements that might influence cash flows at that chemicals or that bank or the discount rate. A third issue that asset owners confront is pressure to adopt ESG in order to satisfy an agenda that may not be their own or what they may not think is their own. Some investors we encountered are exploring ESG with a measure of reluctance because of that internal misalignment between, say, staff and investment trustees. So from time to time, there's an ESG champion on the staff swimming against the stream, but more often than not, trustees have issued a directive to study ESG, which staff questions, or there's some regulatory influence, so friction happens. Now, the situation most commonly arises within public funds for where there is enhanced scrutiny, and there can, in fact, be multiple objectives. And this tension can reveal genuinely differing agendas, but more often than not, the disconnect harken back to some of this confusion around terminology and trade-offs and measurement. This is why we think that clarifying ESG objectives and understanding terminology within organizations is absolutely essential for strategy development and implementation. Right? We know that, for example, Sin stocks may outperform, but they might not align with the values of investors. And on the other hand, highly rated or well-performing ESG stocks can outperform in the future and have lower volatility. So this cautionary dynamic, I think, elevates the importance of aligning on performance objectives and time horizons. These are critical prerequisites. And finally, our clients, they query us on where does it fit into the portfolio? How do they measure it? Surprisingly, my answer of everywhere is not usually accepted at face value. Remember, less than 1/5 of adopters had it in less than a quarter of their portfolio. So they're seeking greater conviction around the value proposition of ESG, particularly beyond developed market equities. They want to know about emerging market equities, fixed income, multi-asset class, and alternatives. And then where in the portfolio is the best place to start? Do asset allocation frameworks have to be adjusted? Unless the funding source is new cash, where do we source the assets from? How do we benchmark it? This benchmarking question has come up time and time again. And again, these are the responses from adopters. There's no consensus on how to really benchmark their ESG strategy. Whatever the case, we believe ESG strategies should be evaluated through the same frames as other strategies, but more often than not, ESG is actually held to a slightly higher standard. We often hear, show me outperformance first and then I'll do it. And it's understandable, right? Think of all the switching costs and the committee work to try and adjust the portfolio. It's significant. But if ESG is a tool to manage risk today and prepare a portfolio for the economy of the future, we can't just wait for that back test to prove it. So the financial imperative of ESG is more important than ever, but we shouldn't lose sight of the purpose of investment finance. What is that purpose? It's to fund breakthrough innovations. It's to reinvest in businesses for growth. It's to create critical public infrastructure, to strengthen public institutions, to endow scholarships. And the list goes on and on. So there's both a nobility and a responsibility in our endeavors to service this higher purpose. And most of you know this. You carry this professionalism with you every day, but I don't think it hurts to be reminded of this, because if you're like me, it gets obscured through spreadsheets and risk models and basis points and committees and alpha and beta and gamma, whatever that is. Who knows what gamma is? All right, somebody, okay, you can explain it to me after. The CFA Institute changed their mission, I think it was in 2016, to note this broader purpose. And it's, quote, to lead the investment profession globally by promoting the highest standards of ethics, education, and professional excellence for the ultimate benefit of society. So with this in mind, I want to discuss the Sustainable Development Goals, or SDGs. They consist of 17 goals launched by nearly 200 member states of the UN in 2015. And they represent an agreed sustainability agenda out to 2030. In a sense, this is our common purpose, our common strategy. And it focuses on areas of critical importance for humanity, protecting the natural environment, reducing inequality, eradicating poverty, etc. They touch every economic sector and will require the alignment and the collaboration of governments, subnationals, the private sector to commit time, know-how, capital, and action to achieve them. And there are some encouraging signs that this is already happening. 75% of the nearly 10,000 signatories to the United Nations Global Compact report that they've developed strategies that align with the SDGs, and that includes my employer as well, State Street. Paul Pullman, who's the CEO of Unilever, said the SDGs offer the greatest economic opportunity of a lifetime. The UN-supported Principles for Responsible Investment, whose signatories represent more than 70 trillion globally, encourages investors to consider the SDGs when making decisions because, quote, they represent the globally agreed world's most pressing environmental, social, and economic issues, and as such, serve as a list of the material ESG factors that should be considered as part of an investor's fiduciary duty. The CalPERS CIO characterized the 17 SDGs as, quote, a gift to investors earlier this year. So collective global action around these SDGs is likely to shape the global economic activity over the next 15 years, creating opportunities, spurring economic growth, and improving livelihoods around the world. So if you think of ESG integration as important incrementalism, think of the SDGs as the moonshot. Right? This is it. Failure to achieve the SDGs, see, I talked about jargon and terminology. I'm mixing ESG and SDGs. The failure to achieve these will have broad consequences, clearly more acute in certain industries and countries, but large and long-term investors like many of us here today who we serve will absorb these impacts. Achieving them will definitely contribute to global economic growth, again in uneven ways, but this growth should manifest to returns to the financial markets over time. Recall that McKinsey work, 28 trillion of GDP from closing the gender gap in the economy. That kind of research is starting to emerge. So for large and long-term and well-diversified investors for whom the bulk of their returns are comprised of beta, the market, taking the SDGs on board to encourage sustainable development is in their own self-interest. And they can be a roadmap to measuring impact at the portfolio. We know that clients want that. They're framed in positive impact instead of risk or controversy like most other ESG strategies. I think one day in the not too distant future, you're going to start to see this showing up a lot more in portfolio review meetings and client reports and even on fact sheets. You know, we're going to get sectors, Sharpe ratio, and SDGs. That's something that we're working on. We have a long way to go. So what are some of the predictions looking ahead? Well, that's one, the SDGs, another acronym to add to the mix that you're going to hear a lot more about. The other is that ESG will go through the is it a factor, is it not a factor debate for 10 or 20 more years. And long before academia arrives at a consensus, investors will have already incorporated into their factor-based strategies. This is already happening today. We're doing this. That pace is going to intensify. We recognize that the term factors in the strictest sense only applies to those durable, academically proven premia that are predictive. What do we have with ESG? Reporting standards that have not been established, data sources are variable or short duration, research is in early days, all the things that we've talked about. But we think ESG is an emerging factor, and we think merging it with factors is a matter of balance because companies with high ESG ratings sometimes have undesired factor characteristics, and companies with desired factor characteristics may not have the ESG profile that clients want. Overall, we found that the correlation between ESG and our factors, how we define them, are pretty low. So really the key to combining them, though, in a multi-factor model is how to preserve exposure to size and momentum, which is not something that ESG naturally has. So modern portfolio construction tools can help meet that balance. Before the factor debate can be settled in academia, there needs to be an agreed industry definition on what is material ESG, and that can't be a long list. Think of value. Everybody defines it a little differently. It's priced to some fundamentals, sales, earnings, et cetera. ESG isn't so easy, right? Because there are those systematic and there are those idiosyncratic and they're time varying and they're industry specific, but we need to get somewhere. We need to get something. And not everyone needs to use them, okay? All right, it's okay if our peers define value a little differently. People know value, all right? It's sort of close enough. We need more convergence. And this is one instance where I think that we as investors shouldn't let perfect be the enemy of the good, frankly, and align on some sort of common standard that sends a clear and strong signal to issuers, companies, of our information needs. And I don't think we can wait for the regulators or the accountants. We might not want to in any event. And finally, I think that we're going to see more and more asset owners in particular, institutional asset owners, adopt ESG benchmarks. Replace them. Replace the standard cap weighted. You've already seen this in some factor indexes. I think you're going to start to see that more and more with ESG. Swiss Re did this, $130 billion plan. They replaced their policy benchmark with an ESG version. And at the most basic level, all ESG is about getting active. Whether it's a simple departure from the cap-weighted index through rules-based filters, to factor-based approaches that are part of the core of the portfolio, to more esoteric, thematic, satellite types of exposures, ESG means getting active. Because these investments by their nature are looking for undervalued opportunities that should be realized in the medium to long term. So this proliferation of indexed ESG investment brings with it important questions about asset allocation, risk models, appropriate benchmarks, impact measurement, but those are really topics for another day. Could talk a long time about this. So I wanna close. And this is what we've been talking about. This is one of the fastest growing parts of the industry, but I think it's really just the end of the beginning. I would ask you to consider embracing the SDGs for a shared and prosperous future. I would say let's keep pushing the science and the research to work out a clearer pricing of ESG factors, especially across asset classes. But let's also be mindful of the art. Right? This is about investing in the world that we want in the future. And let's debate, research, and iterate best practice. But let's converge on this shared purchase so we can do more together. I heard Al Gore say this. I'm going to take it from him. He's duly acknowledged. And he quoted a proverb that says, if you want to go fast, go alone. If you want to go far, go together. We have to go far, fast. Clear, right? Thank you.
Je ne sais pas c'est quoi, mais les thèmes sur ESG, ça augmente la température dans une salle. Mais sans blague, l'air conditionné, en fait, ne fonctionne pas bien, donc c'est pour cela qu'il fait chaud. Alors, on s'excuse pour cela. Comment on va continuer? En fait, je vais demander à Audrey de venir faire un genre d'intervention avec Christopher, et après ça, ça va être une période de questions et réponses. Donc, sans tarder, Audrey Robillard est conseillère principale à d'investissement responsable et procuration chez la Caisse de dépôt et de placement du Québec. Elle est responsable des activités d'exercice de droit de vote, d'engagement et d'intégration des facteurs environnementaux, sociaux et gouvernance pour les secteurs de services aux collectivités. Matériaux et assurances. Elle a également contribué aux travaux de changement climatique qui ont amené à l'élaboration de la stratégie d'investissement face aux défis climatiques de la Caisse de dépôt. Elle est titulaire d'une maîtrise en finance de l'Université Sherbrooke et une maîtrise d'environnement de l'Université Sherbrooke aussi. Elle est diplômée de la France Business School à Tours. Alors, merci.
Merci. Hello. Is my microphone? Okay, great. We shouldn't be complaining about the temperature because we've been waiting for summer for so long. So. Hi, Chris.
Hello. It is warm. It's balmy.
It is. With the spotlight.
It's good to know that it's not just me.
I'll jump in with the questions quite quickly because I'm quite conscious about the time that we have, and I want to leave it up to you as well for all of your questions. Now, you've pursued French courses, is that right?
Un peu.
For your French questions, I will translate with great pleasure. So you referred to a survey that State Street done recently, and 44% of institutional investors said that they integrated ESG factors in their security selection. Now, State Street is a passive investor. So I was wondering, how can you implement a responsible investment approach when you cannot choose the companies in which you invest and when you cannot vote with your feet? Yep. And maybe the underlying question, what to do with the index strategies?
Yeah. Well, I think there's two ways, right? We often say, and I don't think it's just us, but most of us beta managers say that we can't do that. We got to hold all the companies. Sometimes you can, right? If clients give you the permission to do that and the space to do that, then you can make some incremental adjustments, and maybe it's optimization or maybe it's rules-based, and you can bring in that ESG view into the construction of the portfolio for them. And we do that already. We run a lot of different kinds of strategies where we exclude securities that we optimize back to the cap-weighted or these factor-based strategies. But generally, I think you're right. Unless there's a client directive to do that, in any sort of beta proposition, we're really sticking to the index, right? That's what we've been hired to do. But we're doing lots of research on the factor side. I showed a little bit of it here today. But this is why, even when we're passive owners, and we've actually banned the term passive in our firm, because there's a lot of work that needs to be done to be an index manager. To really get that tracking error down, it's not as easy as people tend to think it is. A lot of research goes into it, but also because of the stewardship side, right? So how do we create sustainable value in a simple tracking portfolio? It's by being an active owner, even when we're a passive manager. And like for us, there's no option. There's no option not to do that. That's not something we do at any client's behest, right? We're the fiduciary in that case. We own the right to vote the shares. We're expressing our view, in a globally consolidated way. So for us, that's really how we integrate ESG into index strategies. And I remember I led the initiative for us to sign PRI, and principle one is we will integrate ESG into our investment decision-making process. And everybody was like, no way, like, dragon error, we're gonna get fired. It took a while to get over that hump, but that's kind of what you're asking about. It's about being an active steward of clients' assets. That's the main way, active ownership.
So you're active, and then you try to encourage companies to improve their environmental, social, and governance practices, and you encourage them to disclose a little more as well.
Right.
But State Street is a listed company.
Yep.
And how do you ensure that your own practices are coherent with what the message you're trying to convey?
Yeah. It's hard. We're very careful about that. I think ultimately what it comes down to is that there are no perfect companies. We certainly are not one of them, but we're trying, right? And if we wait for us to be perfect to call for the things that we think are important as a fiduciary, then we've probably maybe breached our fiduciary duty. I hate to say that breach word, but we can't just wait. Our ultimate duty as a fiduciary to our clients, making the corporation look good is frankly second, right? When it comes to gender diversity, we're far from perfect. We don't have the level of diversity that we want at any level within the firm. We've got goals to get there. But it was not so much about us. It was about what we think is important as a long-term investor. And again, if we had waited, I think, till we got there, then too much time would probably pass, and value or money might have been left on the table, and we didn't want to wait for that. But it's not. It's hard. We don't vote. Part of our conflict of interest policy is we own the market, but we don't vote State Street shares. That's voted. That's outsourced to a voting agent. So we don't vote our own shares, just to make sure.
I'll be responsible for voting State Street shares. So.
Be gentle.
I'm independent, in fact. You touched on the importance of data. So investors seem to be craving for more standardized data. Now, can and should all ESG factors be quantified or be measured?
No, they can't. They can't, and I don't think that they all should either. And what do I mean by that? I mean, why does your firm adopt ESG?
Why?
Yes.
Good question. I think there was a great importance that was attached to governance at the beginning, and then it translated into environmental and social factors. And our mission statement is to generate an optimal return and not a maximum return. So I think it sort of legitimizes the integration of ESG factors into the investment decisions.
Yeah. So what is optimal? Right. That's
Good
completely. That's
Hey, I'm
completely.
doing the one. I'm the one doing the interview.
It's hot in here.
It is.
But just to prove a point. I mean, optimal that's not on a spreadsheet. I don't know what the calculus is for optimal.
Right.
Right. If you're looking at reputation risk as something you want to manage through your, holdings of companies, reputation is something that, arguably can be measured, but not really in the portfolio. All right. It's sort of a complex, abstract kind of concept. So. No, but I do think, though, that there is still great work to be done that must be done to measure and quantify this, to keep driving it really deep into the guts and the plumbing of the market, right? It's not quite there yet, and it's making headway. It's more and more in the CFA curriculum now, for example. It's starting to be taught in business schools, but it's not fully there yet. And I think getting this science, as I like to say, is important. But that's also why I said let's not lose sight of the art, right? It's a mix of science and art, but we need to do a heck of a lot more quantification and have some agreement on the metrics and the measurement.
You mentioned the importance of terminology. Now in our field, there's a lot of buzzwords. So there's responsible investment, ethical investment, sustainable investment, stewardship investments, and then we have impact investment or investing.
Yes.
In what impact is different from responsible investing? And do you believe that fundamentally bottom-line driven companies can be said to generate a positive and genuine impact?
Yeah, there's another acronym that I learned called SDGI, Sustainable Development Goals Investment, and there's going to be more. Look, I think that what's the difference between responsible investment and impact investment? I think there is some nuance, but I don't think it's mere semantics. Responsible investment has mainly different definitions, but it's generally meant to refer to the incorporation of ESG credentials into the investment decision making alongside financial credentials. Impact investing, strictly defined, is to achieve an intentional and measurable environmental and social outcome, often first and then the financial return. Right? It's generally project specific. But those lines are blurring, as you said, right? And there's a lot of work. We don't do anything that we say in terms of our strategies as impact strategies, but some of them have an impact thesis associated with them. There's an impact orientation. The gender diversity strategy we created, we're selecting companies that are best in industry in terms of gender diversity leadership at the board and at the management level, and we want to measure that. We want to see that gender gain of that portfolio versus the market. Right? That's gets into the impact realm, but it's a little bit different. So can companies that are public companies, can you do impact investing in public markets? You got to relax the definitions a little bit. I think there are some people that are deep in that impact investing camp who think what we're doing is blasphemy, in the public markets, because we're just providing. It's not original capital. This is in the secondary markets, and so you're giving equity to them, which they can do anything with. Maybe it's a little bit different in fixed income, which is more of a contract, and there's traceability and a line of sight. But unless those assets are ring-fenced from other kind of non-impactful activities. And so anyways, I digress. I think in some cases, yes, it can be done in public markets.
And my last question for you would be, still in your survey, you said that 2 out of 10 investors did not make ESG factors a component of their investment strategy. Now, in case we might have some of them here, what would you say to non-adopters?
Then start with querying your asset managers, and if you use an investment consultant, ask them what their views are, what their beliefs are, and what they can do for you. Start there. If you're an investment manager, you may not be doing it, you may not call it that, but I assure you, you're probably doing something that is ESG-like in your investment process. And I would say, look, if you don't yet have a view that it's going to improve your investment performance and help you make better investment decisions, then at least be open to that possibility. And be careful of what kind of perception your clients are getting about you, and is that client demand signal getting obfuscated, from your own internal processes or points of view? That signal doesn't always come through.
And please, because we need to go quite fast. So, 2 mics are over there, and 1 mic, 2 mics, no, 2 mics. Si vous avez des questions, s'il vous plaît, vous rapprochez. Si vous êtes plus confortable de les poser en français, ça me fera plaisir d'essayer de les traduire du mieux que je peux. Donc, c'est ouvert.
and it's quite all right to ask questions of my moderator. In my opinion. Just kidding.
Hi. If company A that is not compliant to your view to ESG factor acquires company B, which is compliant to ESG, would you buy company C?
Well, there's two answers to that. So if the company C is what remains in the index, yes. In the active portfolios, not surprisingly, the answer has to be it depends. Most of our active, not all of it, but most of it is systematic. It's quantitative or otherwise factor-based. So we don't have, in those contexts, fundamental analysts, really understand the industry and really understand the company and can really dig in and form that assessment themselves. So they're bringing in external opinion and external data on that. And that data, as we talked about, is getting better, but it's not perfect. And there's usually a lag associated with it. That's why we're investing in aggregating a lot of different data and infusing our own insights so that we can be more nimble on exactly that type of situation that you're asking. It's not the answer that you probably want, but I would say it's a very qualified, it depends. We would definitely engage with it, if needed. If it's large enough, and there's a significant enough of a perceived issue-related risk in that company, then yeah, we'll spend time on it through dialogue or if needed through our vote.
Thank you, Chris. My name is JP Renault, and I work in shareholder engagement. So I had a question. You mentioned a very interesting process where you will engage in dialogues with companies, and if really ultimately the results of these dialogues don't go well, you will vote against them. For most of us in this room, there's not the sheer size of your institution. So there's a voting policy first, we vote, then we go and talk to the companies. It's kind of an inverted logic.
Right.
Since you speak to most of these companies, you mentioned huge numbers. What's the motivation for all the smaller institutional investors to go and have a dialogue too? Can you help me out with this?
Yeah. We are in a bit of a luxury position because a lot of companies just want to come to us, and we have to say no now, and are trying to be more proactive and less reactive in that discussion. Sometimes it's for really mundane stuff like, hey, what do you think about we're going to pay the CEO? But, that's not mundane, by the way. That's a bad example because that is important because it's your money. Just getting back to your question, I think that, look, there are great collaborative networks that have been in existence for a long time, including the PRI and others, that allow for some collaboration and the aggregation of points of view into a collective proposition with a company, so that you have a larger voice and you're amplifying that. It's the network effect. I think the incentive there is it's really just frankly, I don't think it's an either or proposition. You either vote for or sell. Right? It's not that binary, right? So in respect, it's just another tool in the toolkit that you can have. It's very important for us, however, because that we are indexed and that we're otherwise not having that, in most cases, that recurring dialogue with them to inform our models after they are thinking of making an acquisition or some sort of joint venture. I mean, we have to do that. We have to do that. But if you're a different kind of manager, then maybe you don't. But I still think that there's tremendous value in using that informed dialogue, because this is about the signal effect and what kind of signal you're sending. And if you can get a network that has a unified point of view, aggregate that capital, then companies might pay a little bit more attention to that. I think that's an incentive, yeah.
I had another question for you regarding materiality, because I read basically all the articles that you published, and in one of them you said that materiality could depend of the sector, of the asset class, and of something else that I'm just forgetting.
Time horizon.
Time
maybe,
horizon, thank
yeah.
you. Now I understand why it would vary with the sector and the time horizon. However, the asset class, it was a little unclear to me.
Yeah, yeah. That's mainly. I think there's a great deal of transference, if I can use that term, between say corporate debt and equity. But when you get into some other asset classes, like private equity, for example, it's a completely different proposition, right? And therefore, there's an illiquidity aspect to it, right?
Totally.
So what are you going to do? You're not really. The issues might be the same in terms of if it's a healthcare company, it's private, right? It's still going to be confronting the same issues. But if they're private, they may not have the same regulatory pressures. They might not have the same stakeholder pressures. They don't have the pressure from the street, from time horizon. You know, so I think these things can interrelate. So it was more around those sort of more alternative asset classes than just, you know, debt, for example.
Okay, I see.
Question here. You mentioned lack of standardizations as one of the main barriers to ESG adoption, but lack of standardization is also one of the main drivers of innovation in terms of ESG metrics. So I was curious as to what was your view and SSG's view on that.
Yeah, that's a great point, because I think we are still at a place right now where there is some information advantage. This isn't really sort of priced in, as I was mentioning. So, you know, if you as an investment manager making investment decisions have that advantage and have that view formed, then you can be early, and you could potentially exploit that. I don't know that all this is going to get arbitraged away, because just how fast kind of the macro picture is changing at the same time. The standardization is important in any event, because I think there's a higher importance associated with this, right? This is not just about alpha or risk-adjusted returns. We know that that's not the ultimate or even the sole objective for a lot of investors. They have this expanded definition of performance. And if we're going to get all the links in the investment chain tied together and linked up, then I do think we absolutely need more convergence. So we sort of want our cake and eat it too. As an active manager, we're happy that things are a little chaotic right now. But as an index manager who's permanently invested, we also want that standardization.
Great, thanks.
Are there any more questions? Yes, mister? Could you please go to the microphone, because it's being filmed. We're stars now.
So my name is Philippe Bélanger from Desjardins Global Asset Management. I'm wondering, can you bring some precision when you said you voted against 500 different companies on the board? You mean some specific board members, the whole board? And what have been the effects of those votes? Have you heard a lot of retractions?
Yeah, it is a focused vote. So it's the chair of the nominating or governance committee. If such a committee doesn't exist, then it's sort of the next best proxy for that. We telegraphed our point of view by issuing the guidance ahead of time. And we sought engagement first. Not all companies were willing to engage. So we hope that most of them, you know, weren't surprised by our vote. Not surprisingly, companies may often get angry with our vote, even if we said, we told you we're going to do this unless X happens. I think after the vote, there's sort of a recognition that, oh, this is serious. They mean this. And the problem with an index investor is, you know, we're not going away. We're going to be there next year and next year and next year and next year and next year. So hopefully that turns into more of a positive feedback loop, right? It's a very important piece of the equation that we want to enact to make sure that this has teeth, right? So we also mentioned that 152 plus have added, 34 have committed out of 700. So I mean, there's still a lot more work to be done. I mean, we want to close that gap. So much more work to be done and a lot more dialogue. And this is resource intensive, but we are by definition in it for the long haul. So we're going to keep at it. You're very welcome. Thank you. And thanks, Audrey, too.
Pleasure.
So, as an asset manager as well, we share a lot of what you have mentioned. And in my discussion with peer asset managers, consultant, and asset owners, ESG factor can improve ROE. That's something that came up quite a bit. Improving investment returns, that's something that we have discussed quite a bit, actually. And we share with you also the challenges and the barriers from data perspective and benchmarking, which is an ongoing discussion, I bet. Avec ça, j'aimerais vous remercier tout le monde d'être présent ce midi. J'aimerais remercier de nouveau Finance Montréal, PRI Québec et IFD pour leur collaboration avec nous, ainsi nos commanditaires Adanda Capital, CIBC Gestion d'actifs, Desjardins Gestion internationale d'actifs, Finance Montréal, Horizon MFS Investment Management, Investissement PSP et Triacima. Et je vous invite de visiter notre site web pour nos prochains événements. Alors, la semaine prochaine, nous aurons une soirée d'Alpha Diversité qui est dans le thème de ESG aussi, avec Carla Harris, Vice-Chairman et Managing Director de Morgan Stanley. On a un atelier pour optimiser vos habilités de réseautage, un autre déjeuner causerie dans notre série de FinTech, l'évolution du conseil financier et l'investissement. Et nous finissons notre année, en fait, le 7 juin avec notre fameuse soirée de prévision. Alors, je vous remercie infiniment et bonne fin d'après-midi.
Hey, merci. Thanks.